Welcome to the video on long-term wealth building after 30, especially when you're juggling multiple currencies like EUR and USD. First, we'll frame the dilemma: how to retain value and maximize growth over a 10-plus year horizon while keeping things simple. Next, we'll share a controversial but practical take on consolidating currencies, then compare an aggressive strategy to a global ETF strategy. Finally, we'll cover how to handle, safe, capital, give actionable steps, test your knowledge with quick quizzes, and finish with key takeaways. Let's begin. Here's the roadmap for today. First, we'll lay out the context. Then we'll discuss why consolidating currencies can reduce complexity and risk. After that, we'll compare an aggressive approach with a global ETF strategy. We'll proceed to constructing a core portfolio, followed by how to manage safe capitals. Next, we'll outline actionable steps, test your understanding with brief quizzes, and wrap up with key takeaways. Before we proceed, a quick but important disclaimer. This video is for educational purposes only and is not financial, tax, or legal advice. Regulations and tax treatment vary widely by country and personal situation, so you should consult a licensed professional in your jurisdiction. All investing involves risk, including possible loss of capital, and diversification does not assure a profit or protect against losses. Finally, past returns or backtests do not guarantee future outcomes. With that in mind, let's continue. Let's set the context. With a 10-plus year investment horizon, simplicity, discipline, and broad diversification are key. Complexity often erodes returns via fees, mistakes, and decision fatigue. When managing EUR and USD savings, the challenge is to retain value, control risk, and maximize growth without adding unnecessary complexity. With that framing, we can move to currency consolidation. Now let's consider consolidation. Holding significant savings across both EUR and USD introduces conversion costs and exchange rate risk as your portfolio grows. By consolidating into your primary income currency, for example EUR, you can reduce fees, simplify tax filings, and streamline tracking. You should also prioritize contributions into tax-advantaged accounts before investing in taxable accounts. However, if you genuinely plan to spend or retire across both currency zones, maintaining some foreign currency exposure can still be appropriate. With currency simplification in mind, we can now map the decision process. This flowchart illustrates a practical decision process. First, ask whether you will realistically spend or retire across both currency zones. If yes, keep a defined percentage in the secondary currency based on expected spending. If no, consolidate into your primary income currency. Next, determine if you have maximized contributions to tax-advantaged accounts. If not, prioritize those because of tax benefits. If yes, proceed to deploy capital into your core ETF portfolio. Finally, reassess annually or whenever major life changes occur, such as relocation, new income sources, or changes in tax status. For long-term growth, low-cost global ETFs make a robust core. This often means using a developed markets index like MSCI World or an all-country index like ACWI. You can complement this with emerging markets exposure for broader growth and small-cap equities to capture potential size premiums. To stabilize the portfolio and reduce drawdowns, include aggregate bonds. The pie chart shows an example allocation, though actual weights should reflect your risk tolerance and circumstances. Above all, contribute monthly. Consistency in contributions typically matters more than trying to time the market. Next, let's contrast aggressive and global approaches. Here we compare an aggressive tilt to a global core approach. The aggressive strategy might put 50 to 60% into the Nasdaq 100, which is heavily concentrated in technology and U.S. large caps. This can boost returns, but it also raises drawdown risk and volatility, requiring strong discipline. The global core approach uses broad global equity exposure, lowering concentration risk. With bonds included, it usually produces a smoother experience and can be easier to stick with for decades. Investors should match their approach to risk tolerance, time horizon, and behavioral resilience. Here are the practical steps. First, consolidate into your primary currency unless you genuinely need multi-currency for spending or retirement. Second, prioritize contributions to tax-advantaged accounts where available. Third, set up monthly automatic investments into your ETF mix to ensure consistency. Fourth, rebalance annually to maintain target weights and control risk. Fifth, Reassess whenever significant life changes occur, such as job moves, relocations, or tax changes. The sequence diagram shows the flow from banking to brokerage to ETFs and the ongoing cycle of contributions and rebalancing. This table provides example model allocations. The balanced model uses 50% in global developed or all-country equities, 10% in emerging markets, 10% in small caps, and 30% in aggregate bonds. The growth model increases equity exposure by raising global, emerging markets, and small cap allocations, while reducing bonds to 15%. The aggressive tilt example maintains a sizable bond allocation for stability, but replaces part of the broad global exposure with a 30% tilt to the Nasdaq 100. These are illustrations, not recommendations, and your exact mix should reflect your risk tolerance and constraints. For funds earmarked as safe, such as a $24,000 equivalent, keep things simple and liquid. Avoid structured notes or schemes that promise capital protection on single stocks because they often have high fees, complex terms, and limited liquidity. Instead, use transparent instruments such as floating-rate short-term bonds or high-yield money market funds available on many brokerage platforms. Evaluate yield against risk and fees, and ensure the product aligns with your liquidity needs and currency choice. Next, let's visualize the journey over a decade. This timeline shows a typical decade-long path. In year 0, consolidate currency and set up automatic investments. During years 1 through 3, focus on sticking to contributions and avoiding market timing. In years 4 to 6, continue annual rebalancing and review tax considerations. In years 7 to 9, increase contributions if your income allows. At year 10 and beyond, reassess goals, potential changes in location, and whether your currency mix still matches your spending needs. Quiz time. The question is, when does a multi-currency savings setup usually make sense to maintain long-term? Option A. Always. More currencies mean more diversification. Option B. Only if you truly expect to spend or retire across both currency zones. Option C. Never always consolidate to one currency. Option D. Only when the dollar is strong. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Keeping multi-currency balances is typically justified when you expect to spend or retire across both currency zones. Otherwise, consolidation can reduce exchange costs, simplify taxes, and make management easier. Here is the second quiz. The question is, what is the main risk of allocating 50 to 60% to a Nasdaq 100 tilt for decades? Option A. Lower fees. Option B. Concentration risk and higher volatility during drawdowns. Option C. Too much bond exposure. Option D. Reduced global diversification costs. You may pause the video now to consider your answer. We will cover the correct answer in the next section. The correct answer is B. A heavy tilt to the Nasdaq 100 increases concentration risk and can lead to higher volatility and deeper drawdowns, which makes it harder to stay invested through market cycles. Here are the key takeaways. First, simplify currency exposure unless you genuinely live across multiple zones. Second, build around low-cost global ETFs and complement with emerging markets, small caps, and aggregate bonds. Third, automate monthly contributions and maintain discipline with annual rebalancing. Fourth, for safe capital, use transparent options like money market funds and short-term bonds. Finally, avoid complex, high-fee products that promise protection but can undermine returns. To summarize, consolidation can reduce friction and risk unless you truly spend across multiple currency zones. Global diversification should anchor your portfolio, while any aggressive tilts demand discipline and rebalancing. Protect safe capital using simple, liquid, and transparent instruments. Over long horizons, consistency is more important than timing, so automate contributions and rebalance annually. With that, let's close out. Thank you for watching. If this video was helpful, please like, share, and subscribe. In the comments, share your current currency setup and ETF mix so others can learn from your approach.